for joining us. And today I'm going to be sharing a whole lot of the comments, process, discussion around the things that we've been doing with advice firms. So this is all part of my attempt to build a non-aligned voice for the advisor community so we can actually get some of these ideas out and being discussed. And so I'm going to give a little bit of a disclaimer for those of you who are joining in with us, because I know we've got some structural engineers, we've got accounting firms, we've got some law firms. Primarily my message or my language that I will be using today is aimed at financial advisors. And there's a couple of reasons for this. So first and foremost, at the Social Advisor and across the last 23 years of my business, I've been advising people in and out of business. I've been a financial advisor for 15 years. I've built an advice firm. I consider myself to be an advice nerd. Now, the concepts that we're going to be talking about today will absolutely apply 100% to any advice and services firm. You will just need to take a look through the specific language that I'm using in today's session because it's aimed at the financial advisors in purely that sense. And the reason for that is because going through the Royal Commission, and there's a whole lot of changes in Australia. And by the way, these changes are happening globally, whether it's South Africa or Canada or the US, etc. There's a real impetus of change happening. And I believe that's the case across the three major professions that we typically work with, which is financial advice, accounting, and law. And that impetus is increasing. And in the case of the Royal Commission, I just want to talk a little bit about why some of these changes are so important. First of all, the cost to deliver advice as a financial advisor is increasing. Secondly, what used to be slightly viable as an advice firm before, in the new paradigm, won't be. And when I talk about EBIT models, and I'll jump in to speak about that in a little bit, what we actually find is that there are also a whole lot of financial advice firms out there in this country that if their grandfathered commissions are removed from their fee for service schedule that they're building as part of their normal advice businesses, then their businesses are not viable at all. And so the impetus for this conversation is pretty extreme in that sense. So I just wanted to give that disclaimer. The concepts will absolutely apply across any advice and services firm. Now, I'm very well known for technology and using systems and for social media in and around advice. And I love all of those things. We've built a 200 or thereabouts point checklist, which can accurately predict an individual advisor's organic client referral rate. I've been using video to engage and serve clients from when we used to have to ask them if they had a beta or VHS cassette player. However, the things that I'm talking to you about today are actually the fundamentals of advice business models. So I will get into a little bit of how we actually help firms scale beyond a certain point. But almost all of those things are largely in the shadow compared to the core business metrics of advice firms. And that's where the greatest change comes from. So they're the things that I'm going to be speaking about today. And if I get fired up and I'm reasonably passionate about it, it is because my whole life has been based around advice. Everything that drives helping people to have better lives as a profession. And that's something that's really, really, really important to me and the reason behind everything that I do. So if you're watching this stream on YouTube, which is where we're live at the moment, then could you please do me a favor and make sure you've subscribed to our channel and to share this material. So the idea here is I'm not going to be giving you a pitch that relates to the social advisor or myself or anything else at the end of this. My goal is to get the conversation going and to share the lessons that I've learned through my obsessions and to find other people that are learning great lessons in the advice space and to bring that together collectively. Certainly in financial advice, I think a lot of the information that's been out there has been limited through dealer groups or product providers or through associations that have to negotiate with politicians. They have members, they have sponsorship, they have all of those things. The conversation that I think really needs to be generated is one that exists between advisors and removing that cap of open conversation and debate. So that's exactly what we're here to do. So now that we've said all of that, let's get into talking about some of this today. So before I move on, let's ask the question, well, what is EBIT? So as we were leading up to this, part of what I was saying is, how do we consistently help firms move from less than 30% EBIT to above 55%? And again, I want to give a few disclaimers around what this means, because it's different for all businesses and depending on your stage. And I was talking to one of our community members yesterday who's a law firm, and he was saying, hey, can you kind of get into the nuts and bolts of EBIT itself, which, coming from the financial advice and accounting background, one can take for granted. So EBIT is earnings before interest and tax. So it is a measure of the core profitability of a business. So it excludes the tax you're paying, and it excludes the cost of borrowings that you've incurred in building the assets of the business. So it's your profit measure before those things. Now, I think one thing is really important for us to talk about, because when I say this to you, I've had the chance to look behind the scenes of coming up close to 500 advice firms of all denominations. And so I think I'm going to use this analogy with you all this morning as well. I work with people who have advice as their religion, if you like. We're all part of the same religion. There's just slightly different denominations, whether that's financial advice, accounting, law, etc. And so the language changes between, but the one thing I have seen consistently is this. Earnings before interest and tax also means making an allowance to pay the principal and the senior people within the business a salary or an income that is commensurate with their personal exertion. And so when we actually look at the numbers, and I say to you that most advice firms that I've come across don't actually operate above 30% EBIT, then you also have to take into account that a lot of those businesses are also not paying their owners and their founders a significant earnings before they calculate what we're referring to as earnings before interest and tax. So a lot of the times it's not a 30% EBIT or a 25% EBIT, but when we actually say, hey, look, as a principal of a business, if you were an employee, you wouldn't go to work for someone else without getting paid $150,000 or $200,000, and it depends on the individual business owner's experience and situation. And you have to actually factor paying yourself that before you calculate your EBIT models. So before you calculate whether your business is actually viable. Now, this leads into the next question that we're talking about, and is it okay for an advice business to make a profit? And I know that might sound fundamentally a little crazy to you, but one of the things that I challenge advisors on all of the time is that they have a conception behind the scenes that making an excess profit is something that perhaps they should be guilty about. And I think this is a societal misconception. It doesn't actually come into business principles. And I look in accounting firms, and we look at how they're charging and how they're pricing and how they're running their models. And it's really simple. It's not what they would advise their own clients to do. So that's what we're going to get into today. What are the things that we typically can pull the levers on to take an advice firm from potentially significantly less than 30% real EBIT and take them up into the 40s? Now, when you go from below 30% EBIT to above 40% EBIT, you start to see some radical changes. And I think this is actually one of the areas where technology companies and people that focus on systems and process kind of miss the mark. And it's certainly the area that I would have thought made sense. Come into a business, create better systems and process, alleviate some of these issues, and then you can free up resources to be able to go into other things. The reality is that unless you have your core pricing, value articulation model, revenue streams sorted first, You don't actually create the space and the capacity and the cash flow and the resources to then go to the next stage, which is building all of the efficiency in. So typically when we talk to advice firms now, and I've put out a video on this recently, don't talk to me about marketing when your business model sucks. And what I mean by that is we shouldn't even be thinking about getting new clients. If you're a business that's existed for more than 4 years, then and you've done reasonably well in terms of client growth, then chances are the focus would be absolutely nothing to do with taking on new clients. And that's one of the first fundamental mistakes that I want to talk about. Businesses struggle with this idea of cash flow and resourcing. And if only we had more better clients, then we could afford to do some of these things. In reality, what we actually find is that we have to look at the existing business, the existing value articulation, how you're pricing to existing clients, change those things. And that's almost universally how we move to that above 40% first hurdle point. Now, once you reach that point, you actually have capacity. You have capacity to invest in things. You have capacity to start going deeper into what you're doing with your clients. And it's at that point that you can actually start building systems and using technology and making it stick because you have the resources to do so. And again, it's still that combination of from 40 to 50% thinking about how we articulate value. So it starts moving into the really honing in on who are our clients, how do we serve, how do we articulate it to them, what is their value, and how do we reach them. So I'm giving you an overview before we start delving into the key issues here. So now as I move on, once we get beyond 50% EBIT, it's all about process and technology and systems and becoming recognized for the kinds of work that you do and going much deeper individually with every client. So that's our overview. Now we're going to get into some of the key issues that I think you need to think about. So before I move on, really, I want to say this to you all. I believe advisors are the sleeping giants of our society. If we can have you all increase your profitability, to be honest, I'm not here to help you make lots more money. I'm here to help you make more money and be more profitable because you deserve to be. And because without that, you can't go deeper to have more impact on the people that you serve. It's not a chicken and egg question. It's one leads to the other. Advice firms provide something that is so incredibly valuable to their clients that it's completely unreasonable for them to not be making more than 50% profitability. And unless they do, they don't have the headspace, time, and resources to actually be able to go deep enough and to have the maximum impact with their clients. And that's absolutely what I've seen in having run my own advice firms for all of my adult life and having worked behind the scenes with so many. So let's kind of move on to thinking about what some of these key issues are. Well, the first thing that I want to talk about is it's actually the first principle: what you think is true is true. And in the world of financial advice and accounting, these are very, very similar crossover between the two. But as I said, I'm going to speak from here on out primarily using the language of financial advice. So every single business that we've been into has a value articulation problem. They're not doing it at optimal levels. And they also have a ceiling that they put on their ability to produce profit, which is first and foremost a psychological one and not a systems-based one. So the psychology of the business owner always comes first. What's in the headspace of every single advisor determines what the value experience is of the clients that they actually serve. So if you believe that your job is to give as much away to people for as little charge to them as possible, then it's a fundamental broken perspective. And what I find is when we work with advisors, they don't know their own biases. And to be honest, this is the same for every single human. So the reason advice is so important is because it's almost impossible to see your own limitations. It's almost impossible to see your own sticking points. And the same applies to people who run advice firms. So that's the first and foremost. Now, I'm going to delve into the kinds of thinking shifts that need to take place in order for you to move your business into actually being a real business with real business practices that delivers absolutely in every situation a greater sense of value to their clients, more life change to their clients, and profitability at the same time. All of those things fit together. So the first point is most advisors have a complete ceiling when it comes to what they believe is the value of what they do. And in some sense, this has been indoctrinated into us through the provision of product, the fact that we look after superannuation, or we manage portfolios, or we provide reviews to clients. And even the concept of fee for service is actually creating a psychological cap on an advisor's ability to perceive their value and articulate it to clients. So think about the term fee for service. What does that actually mean? Fee for service. It means a fee for actions taken, a fee for steps delivered. Now, yes, we all are here to serve our clients, but in terms of the things you deliver, it's not a fee for service that's important, it's the fee for value. And if we look at advisors' financial services guides and how they articulate what they do, and so often we see as the price goes up, they're trying to deliver more meetings to clients, more reviews, more paperwork, more of the things to justify the fee levels that they're creating. And in essence, that comes to a fundamental blockage of how they've articulated value to their clients in the first place. Now, I could literally speak for days, and I do, about the nuances of value articulation and engagement. But the first step is to understand that an advisor's role isn't to give advice or to carry out tasks or actions. And by changing your own understanding, you can actually be in the right point to make these changes. And so what I think an advisor's role is to help clients to find their own answers. It's not to know the answers to give to someone. It's not to advise them on the things to do technically. It's to help the client discover their own answers. And then depending on your denomination, to have the ability to make that change cascade, whether it's through their investment choices or superannuation, or like we do, we're advisors to advisors in helping them with the tactics and the steps and the accountability and the change management to make the behavioral aspect stick, to give people what they want to have a better life. So if I were to bring that together, your value is never the actions you deliver. Your value is helping your clients to recognize their own answers and to have a better life. And how we do that is by digging deeper with clients to find where they're at in their life, what their pain points are, where they're suffering, where they need help. Paint the picture of this is where you are, this is where you want to be, and this is how we help you get there. And this is why you're going to pay us and why you're going to engage with us. The concept and the sale of your own answers to get to where you want to be in life is the starting point. And almost all advice firms bias that first encounter with their denomination, if you like. So it's selling the things that are the technical bits rather than the religion itself, rather than we're here to help you change your life. Now, this leads into other biases which are really fundamental across the advice space. So first and foremost is this concept of what a client should pay for a certain service, not necessarily value, but for a certain service, dependent on how much they earn or how much assets they have. And this is actually a misconception and leads to one of the biggest areas where almost all advice firms we've come across have got a major EBIT problem. And that is the minimum revenue that they receive from clients. So if we're talking specifically in the financial advice space, if you're receiving less than, and it depends on your model and it depends how you're set up and how many, where you're going with your business. But as a general rule, $4,000 to $4,500 per client is the minimum threshold that you can be generating an income, providing any form of real service to a client and not be losing money. So the first step is to understand minimum cost to serve. And that's a process of going through and looking at it individually for a business. But if you want me to make a generalization, I'm going to draw a line in the sand and say that starts at 3,500 and the range is 3,500 to 4,500, 5,000, depending on the firm as to what the minimum cost to serve is to have a real advice client. And so some of you there are probably thinking, well, how do I justify charging a wealth, accumulator? So there's two scenarios where this might come in, a young couple, maybe they're in their early 30s and they're only earning, 120,000 between them. That's a significant portion of their disposable income. Yes, it is. And so is the impact, the life impact of having an advisor who can talk to you, that can help you get your head straight, to bounce ideas off, to question you in the right way, to help you be accountable to yourself. And so what we find is, even with advisors that have clients that are in that scenario, just by articulating the value to them, you can increase your client base in that space from maybe you're earning $1,000 on some insurances or whatever it may be, and put a fee to them where you're actually going to meet with them and go deep with them in terms of questioning, and have most of them agree to actually take that up. So that's the first thing. The second thing is, well, what if I've got, the nice old lady and she's got 150,000 of total investments. And so this idea that 1% of portfolio is enough to justify what you're delivering. And the truth is that that doesn't work either. And a minimum cost to serve isn't just your cost to deliver. It's a minimum cost so that you are paid enough for your risk and for your investment of time, for your willingness to take on the difference between a business owner and being an employee, which is significantly different. So there's also a minimum profitability level that you need to be charging to clients. And this is a confronting topic because, as I said, most advice firms will have a large section of their client base where their minimum revenue earned is not sufficient to be a viable business model. And I've heard every possible argument that you could imagine around, well, we don't do much for these and we don't deliver. And so maybe we can just build a set and forget model. There's opportunity cost to everything that you do. You only have so much headspace as advisors and as principals within your business. And that headspace needs to be invested in the most impactful way. So in every circumstance where I've seen that happen, the opportunity cost where they justify this percentage of their business is okay to receive the revenue, because if I let the revenue go, then my business isn't viable. Well, the truth is it doesn't work anyway. And when you actually go back to your clients, even the ones where you're only earning $600 or $1,500, and you say to them, this is the kind of business we want to build. This is why we're doing it. It's not for everyone. We understand that. We have to make an election that we want to be in business and honor the principles that we advise you on. By the way, this is where you are. This is where you want to be. This is how we're going to help you get there. And despite the fact that you might only have your $150,000, it's still worthwhile for you to pay us $4,500 a year to get the life benefit change that you have. Now, in most cases, you don't need to say that to clients. They will say it to you. And that's how we know the value that people perceive in what they're doing is significantly higher most of the time than the value the advisor perceives at the same token. So the first step is you cannot run your business without understanding your minimum cost to serve and without universally going through your entire client base and drawing a line in the sand. Now, there are a couple of exceptions that I will make to this, and that is sometimes you might have the little old lady client, and I'm not being derogatory, I'm just painting a picture because maybe her husband and her were some of your early clients, and maybe you promised her husband before he passed away that you were going to look after her. It's okay to have some people in your client base where you're making an exception. It's okay. It's just that it can't be the default rule, and you cannot do it without intent. So a small handful of clients where you're losing dollars, okay. But anything more than that, and you're actually a charity. And not only that, the next thing I want to talk about is the fallacy of the worth of a business owner. Because most people go into their business in the first instance and they price their clients based on their own personal exertion. And so business owners typically have a higher capacity to produce outcomes than someone who remains an employee. Now that's not one is better or one is worse. It just means you're going into business, you're going to have to hustle harder, use more of your energy to push harder, take on more risks. And what we tend to see is a business model that reaches its absolute cap on what it can do because the price point was only viable based on the excess capacity of the advisor themselves. And once you've used up that excess capacity, which they're not really being remunerated for, people get stuck. And the truth of it is, in almost all of those scenarios, is because you're not charging enough, understanding your own value, and challenging the perspectives of yourself. So we've helped so many firms go through this process, and universally, these are the key concepts that we come across. Now, all of these things might seem reasonably simple to you. And I'm going to kind of take a bit of a detour for a second here and talk through, well, how do you make some of the changes we're going to be speaking about today? Well, the first one is to be aware of them. So hopefully what I talk about in the rest of today's video is going to help you significantly to understand where you can pull the levers in your own firm. But that's generally speaking not enough. And I can use that by painting a picture and saying, well, there's three ways we typically help businesses. We run programs. So we've got workshops, and we have a module called Realign Your Business and another one called Pricing Advice. And we tend to combine that together with another program called Ignite. So it's self-directed. We'll teach you how to do it. We'll give you all of the tools, and then we'll allow you to go and do those things yourselves. Now, that's been incredibly successful. But generally speaking, we'll see an uplift in revenue within a client base in that scenario of somewhere between 10 and 15%. On the flip side, the next level is doing it together as a project. So doing it in lockstep and checking in and getting support, etc. And doing that in a consistent way means that you're being held accountable to the things that you're doing, that you're not just letting things slip through. And typically that's far more successful. So we see an average uplift of between 15 and 25%. Or the next stage is actually going through this with someone and literally client by client. Well, who are they? Where's this relationship come from? What are your biases? How are you articulating this? What do they actually need? What should your price scenario be? Talk to them about this, dig here, find this out, now articulate this and put the new fee to them. By doing that directly with people, we find that the uplift in revenue is typically anywhere from like a minimum of 50% up to 200 to 300% of revenue. And I know that might sound particularly crazy, but especially you think about the bottom end. If you've got clients that you're generating $1,000, fees from, and you put something else to them and 95% of those clients say, hey, we're coming on board, well, that's 4 times the revenue or more. And we typically find that's actually the results that we encounter. So the reason that I covered those 3 models wasn't to sell you any of those services. It's because that shows you how fundamental the biases are. The reason it actually works that way to such a degree is because it's so ingrained that you need help to go through each of these steps and to understand it and translate it across the business. So that's the first major area that we see with firms. And as a general rule, the minimum cost to serve implementation will uplift EBIT for a business anywhere between 5 and 15%. Just that one factor, depending on how much of this they've done already. The second scenario is in the complex years for clients. Or in other words, another way to look at this is doing work for clients for free just because you have an existing model with them. So let's paint the picture for the financial advice scenario. So you've had a client for 4 or 5 years. You've been, helping them build their portfolios and make better decisions and all the rest of it. And now they're moving into retiring. So the first year moving into retirement is exceptionally complex. So it can be 2 or 3 times the amount of work that you would do in a normal kind of hands-off or a more hands-off year with a client. And so what we see a lot of advice firms doing is this concept of swings and roundabouts. Well, they've been a great client, they've been very loyal. We've made good revenue. We've made a good profit from our work with them. They're no hassle at all. And so we'll kind of do the work for them, and we'll either charge a little bit more or not significantly more. And the problem with this scenario is at any one point in time in your advice business, you will have somewhere between 15 and 25% of your client base in complex years. So you think about this. If you're a business doing, I'll pick $1 million just because the number's round. If you're doing $1 million in fee revenue with your clients and 20% of your clients are in complex years, and on average, those years you're doing twice as much work for those clients, then that's $200,000 worth of revenue. Now, it's a very straight line number. Often it's actually significantly more. And what we know is when you go to a client and say, hey, look, this is what we're doing. It's a complex year. We're going to charge you more for that. And this is the reasons why. The clients will be happy to pay that. That's a business decision. And almost never in any of the things that I'm talking to you about today with regards to pricing and communication with clients, will you have a significantly higher proportion of your clients say no than are saying yes now. And this is really important to understand because it's a big fear that advisors have. If I push these things, then a client may say no. And we all have a fundamental issue with self-worth, every human being, and that translates differently for all of us. And sometimes that's the fear of rejection in the client relationship itself, which is also why we find it much easier to repattern advisors with brand new clients than we do with their existing clients. So when we go through and make these changes and build new fee models and all of this stuff, we find that often they'll stick to it with a brand new client, no problem. And the clients are just saying yes, 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 and they find it amazing. But they're not going back to their existing clients and saying, hey, this is where we're at. This is what we're doing. We're doing this because, and we have a whole process for how to articulate change in any circumstance. I won't delve into that today, but going back to them and having your clients say yes. Now, we've helped dozens of firms this year to go through this process. And the interesting thing is when I've asked all of them this question, in going back to your existing clients and repositioning your value and your fees to them, the clients that were actually clients, the ones that you liked, you wanted to have, and were engaged with you on a proper model, how many of them have said no? And across the hundreds of clients that have just been in the last few months, the answer is actually surprising. It's zero. So 0 people have said no to this. And that's a key indication to you of the seriousness of what I'm talking about. It's in the advisor's head, not their clients. So that includes for the minimum cost to serve increase, etc. Now, having done this many times before, I'll also say this to you. Typically, you can expect a loss rate of a couple of percent. But even if you're expecting a loss rate of 20 or 30%, and you're taking, 300 clients often at the, this bottom end of $1,000, and you're changing that to a $4,500 minimum income level for a client, and 30% of them still said no, well, you're still doing a multiple of revenue for significantly less work. And what I will also tell you is that almost universally, the clients that say no to these changes are the ones that were the most difficult anyway. The ones that were consuming the most time and the most effort are the ones that say no. So you think about the radical shift for some of you that are listening into this, how much that would be. It's like just that one change. So as I said, the second area is in complex years. That also includes the first year of a client. I find that most advice firms will typically be very soft in their additional fee in that first year. And for most clients, you're talking 2 or 3 or 4 or sometimes 5 times as much work as you would do in the average year for that client in that first year of engagement. And I think, again, this is a fear of losing the opportunity, losing the new client. And if we extend that back to the philosophy of running an advice firm in its principle, if you're running at less than 30% EBIT, or in fact anything less than 40% EBIT, then you have to be feeling some pressure, some risk with your business. So whether it's cash flow, whether it's the pressure on you as the principal of the business, because at less than that, you're using your excess capacity in most cases to prop up the business rather than having the resources to deliver. So, we see this as a fundamental component of how you price out your business. So if I come back to this and say, if you're in the first year with a client, it's typically going to be twice as expensive as an ongoing year. And not only that, we also see many firms delay when their ongoing fees commence. So if you combine those two factors together, maybe, if we're talking financial advice, maybe it's $1 million client. And what I mean by $1 million is you're picking up $1 million of funds under management. So the financial advisors, that means the percentage of a client's portfolio that they're actively helping the client manage. By the way, I think that's a poor standalone indicator of what your value and your fee should be, but it's definitely part of the indicator mix. So maybe that's a 10, 12, 13,000 ongoing fee for that client, depending on what you're delivering to them, before we move into another point that I'll talk about in a little bit. And typically we'll have advisors charging an advice fee up front for a client. It might be $2,000 to $5,000 for that client to do a plan. Well, in reality, the first year should probably be something like $20,000 to $25,000 for that client. And not only that, if you've articulated the value in a different way, this is where you are, this is where you want to be, this is how we're going to help you get there, and you reframe everything that you're doing into the life benefit of the client, then the chance of them saying yes is exceptionally high. Now, I'm going to circle back to some points that I was making before. And that is, we don't see you losing more clients by adopting this philosophy. Sure, some of the people who may have said yes that were more focused on price might say no. But quite often, some of the people who would have said no before, because you failed to push them on the value and to understand it and to take it seriously, will actually say yes. And more importantly, more of the right clients will turn up and want to do business with you. And let's just think about it in pure logical terms. 4 borderline clients versus 2 very profitable perfect clients, which is better from a business scenario. So we also advise advice firms, at least psychologically, to be pricing so that they're expecting clients to say no. And when you do that, it generally doesn't lead to clients saying no. It actually leads to your value being better articulated, to them perceiving value better, and to you actually having a relationship where you can afford to go deeper with them as a client. So that's the second area. So number 1 is the minimum cost to serve. Number 2 is the complex years, either undercharging in the first year or moving into retirement, etc. And as I said, that's usually somewhere between 20 and 25% of clients in any one year. The next scenario that I want to speak to you about is this, and that is a failing to charge clients for work that's right there in front of you, that has a direct impact on their life, that you're helping them with anyway, but not charging for, and then never going hard enough at to have the greatest impact for the clients. Or in other words, we can call these project fees. That's a simple way to look at it. And so if you're a financial advisor, then typically you've been, positioned into this box of, you talk through the goals and objectives for a client, you dig deep enough with them to find out their goals, but it's still only really at what I think is a surface level point of view. They bring up questions and concerns and fears, and you talk through it with them, you help them resolve some of these issues. And that's the bit where you're really starting to make a life impact change for them, and often not charging for. But then, because it doesn't relate to the box that you've created, for example, the getting the $1 million into a self-managed super fund as an example, or the managing the client's tax returns and compliance if you're an accountant, and doing business advisory as it just relates to the cash flow and structuring bits that your denomination relates to. Instead, forgetting about what your role is, and instead understanding that as an advisor, you are completely trained in the art of deep questioning, even if you haven't been doing it properly, and helping people take a step back from their situation to look at any of their problems objectively and to work through a plan to solve those issues. You're all trained in this. That's what you do. And I've had as I've talked about these things, I've had a lot of objections, like, yeah, but I don't have a life coach qualification, or I'm not specialized in this, or what. You don't have to be specialized in anything other than deep questioning, helping people put emotions in context, and using your logic to come up with a plan to solve something. In other words, if you're going deep enough with a client, then every year in your client base, you'll have another 20 to 25% of your clients that need deeper advice help to solve particular scenarios in their business, that they don't have someone that understands them. They don't have someone capable of the things that we just spoke about, and therefore they just never get resolved. In essence, however, if you understand how to draw your clients out, how to create that this is where you are, this is where you want to be, this is how we're going to help you get there, then any scenario they've got, whether it's dissatisfaction with their career or a misalignment of their business or family issues, or they're trying to buy a new house and coordinate things between that, it could be anything. It's very easy for you to go, you know what, these are the steps that you need to take. You need someone to help you go through that, to speak to you around it, who knows you and is going to keep you accountable to getting where you want to be. And clients will pay for it. And typically for those projects, we would again expect there to be somewhere between 50% of an annual, their annual normal recurring revenue, to anywhere from double upwards of that average year. So again, if you understand this and you know how to build it into your service model, then that's another, for $1 million firm, again, you're talking another $200,000, $300,000 worth of revenue. Now, if I combine the factors that we've already discussed for that style of business, we're already talking about an uplift of somewhere between $500,000 to $700,000 worth of revenue before we have taken on a new client. In fact, we would expect the most difficult clients to have left through this process or to be re-engaged under a new process with a different philosophy of what the value is, so that you're retraining them to be better clients. So not only are the clients better behaved, they understand the value more. You're translating everything you do not in investment returns, not in how much tax you've saved, but in the life change to them. You're getting them to articulate back to you explicitly what that life change has been. Their satisfaction levels go up, their sense of value increases. The fact that you've created some price tension with them to seriously value what you do means they perceive it as a higher value thing. It also means they refer more and will talk about you more. So taking businesses through all of these things, every single time we do, the referral rate goes up. So does the satisfaction of clients. Now, I'm going to paint a scenario for you because I've heard plenty of objections. It's a real change management issue in walking through this. So my clients won't pay that. Well, really, that's not been our experience across the entire demographic border of clients, whether they're high net wealth individuals or they're, people who don't have much assets, whether they're wealth accumulators, etc. It's all about how you articulated your value and whether you believe it or not. And again, I'll use the idea of a retiree who's just got a little bit of dollars. Do you know how much difference it actually makes to someone's life to have someone every year go, you know what, if you just do these couple of things, then this is the best option for you and you're okay? That's worth a big chunk of what you have, because it actually changes your life. It actually has an impact or a life value far beyond the technical dollar value return. So again, if we're looking at that scenario of an advice firm, $1 million has now become $1.7 million. How much more depth do you think you can deliver to these clients? You now have the time and the headspace to be able to do so. And some of that increase in revenue can go towards you building better systems, you implementing better technology. So what we actually find is that the clients start getting a much better level of client experience as a causality outcome from this. Secondly, every client, you're going deeper with them. You're understanding their life. You're making them answer questions they've never thought of before in a more fundamental way. Now, almost all advisors I know have these moments and do this by default with clients, but they don't go far enough, in my experience. And again, I've gone deep into hundreds and hundreds of firms. I've had this conversation one-on-one with thousands of advisors over the last decade. I've been there myself. When you really go deeper with clients, when you're looking into what their relationship is like with their kids and their spouses and how they feel about their jobs and their sense of fulfillment, you're really positioning yourself as their partner in life. And the beauty of this is the revenue increases at a much higher proportionate rate than the cost to deliver. Because you sitting down with a client and working out a way to delve into this stuff, it's your one-to-one time. It's your greatest leverage. So you don't need to have complex portfolios and compliance standards and SOAs and all of these things happening behind the scenes to deliver this excess capacity in terms of value impact for the client. And people will absolutely pay for it. Universally, this is the case. So you combine all of that together, now you can start to see how we're moving from EBITs of sub 30% into well and truly into the 40s. So what makes the change between there upwards? Well, we'll get to that in a little bit. I still want to go a bit deeper in terms of pricing and some of these things as well. So the other area that we see a fundamental cap is on the dollar amount upside. So it's a bit like the 4-minute mile, if that makes sense. So if you all know the story of the 4-minute mile, people believed that you couldn't run a mile in under 4 minutes, and that was the cap, and that lasted for a very, very long time. And in 1 year, a person broke the 4-minute mile, and then in the subsequent years, lots of people broke that time limit. It's about what your perception of what's possible. So you have this threshold level. And it was only on Wednesday we were having a conversation with one of the firms that we work with. And he was talking about this particular instance and saying, look, we've just learnt this lesson again, Baz. Thanks so much. You've helped us to really reset this. And, we took on $70,000 of extra project fees last month that we wouldn't have had happen before. And then we're looking at it and saying, well, we just priced this CEO of a business $28,000 to do this project that was related to their scenario. This is outside the scope of some of the other things that you would normally consider to be financial planning. And he said, and he didn't even blink, he accepted it straight away. And I talked to my business partner afterwards, and we realized that's because he knew it's exceedingly cheap. And we should have charged more for it because we're delivering immense value with the work that we're doing. So if I were to sum this up and say that in fact, every firm and advisor has their own ceiling on how much someone will pay, on how good a client will be, etc. And changing that is the first step to actually making the fundamentals change within a business. Now, again, I'm making generalizations here. There are all kinds of different advice firms that specialize in doing different things with different people who have different economic circumstances. Universally, the principles that I've spoken about today apply across all of those firms. The metrics will just be different. The numbers will be different. Some of the language and context may be different, but the principles are the same. And if you then cover that to any service business, the principles are also the same. Understanding your value, articulating it the right way, being unflinching in the way you deliver your value to clients, being unflinching in the value of that translates that value to people. It's one comes before two. It's not that you experience, it's not that your clients get better, it's your definitiveness of your own value. And that's where we actually have the biggest change with firms. I would love to because analytical is one of my personality types, I would love to just give you here's the complete step guide, follow these steps, you get this outcome. In reality, how we've managed to figure out how to get firms on this path is 98% of it's change management. The 2% is in the process and the techniques and the steps and the systems. And by the way, all of those things have to be there. So it's a 2% which is 100% relevant to the outcome. So it's not that you will get 98% of the benefit without those things. It's that 98% of the impact comes from that, but you still need the other 2%. I hope that makes sense. Kind of reminds me of the Naked Gun movie from years ago, and I'm showing my age. And he's talking about, he's got a 50% chance of making it through, and there's only a 40% chance of that. Anyway, that's my dad jokes for today done. So let's kind of move into thinking about what happens after pricing and value articulation. Okay. So there are certainly elements that you need to understand in terms of scaling business. What we find in almost all advice firms, that their organic client referral rate is particularly low. And I think it's interesting that I was reading yesterday in the Kitz's report. So Michael Kitz's, for those of you who follow him with a nerd's eye view, did an analysis of a report that was done in the States about where financial advice firms are getting their new client acquisition from. And the overall summary of that was to say that the reliance on referrals was way down. That wasn't where most firms were getting their business from these days, where it was in the past. I actually think that the conclusions they reached were slightly off the mark. The reason that we're seeing client organic referrals go down proportionately is because advisors don't understand how social media and technology has changed that referral process. So there are a lot of key elements to understanding organic referrals. By the way, the biggest single multiplier is price tension. So if you've articulated your value well, if you've helped a client to see their life differently and to think differently, and you've really got them to think about how much they're paying you and there's some price tension, that's actually the biggest multiplier of organic referrals. But it only multiplies your ability to receive referrals. And that's why having a website that tells your story, that isn't a pitch, that isn't a CV, that doesn't list out your qualifications and the services that you provide, but actually tells your story, your why, that shares your client stories, that helps them get past their fear of the experience. That's why all of those things are important. It's why it's also important to build an online brand. Because today, when someone makes a referral, people don't just act on one instance. They'll get the referral, they'll Google you, they'll wait a period of time, they'll ask other people. And it's the combination of all of those interactions that leads to the successful outcome of referrals. And so this is all a causality tree, because if you've gone through this process, you become exponentially better at articulating your value in the right way that has the right impact. You've been forced to confront yourself about your own value. You've had your clients do the same thing. So we find that the quality of referrals that you get as you go through this process increases. So I call this the difference between being referred down. So let's take that $1 million client as the base example. So they refer you their nephew who's 26 and has got no money and has got a gambling problem. Can you please help him? Well, that's an extreme example, but that's referring down versus them saying, we've done pretty well for ourselves and we're happy with that, but would it be okay for you to talk to our friends because they're worth 10 times as much as us and they need your help just as much as I do? That's referring up. So that's important. Having an online presence. People Google you by name. Referrals are generally made to an individual by name, not to a business. And again, this is a fallacy I see. So people spend time building websites and trying to put a corporate emphasis on the language and the story instead of an individual emphasis. That's a big change. And what people find when they Google you, your advisors, your team members by their names impacts their decision to engage with you. And again, as I said, we've got an entire algorithm which accurately predicts the organic referral rate of clients. So these are the things which will help you to start to scale your business. By the way, when you're in a situation where you're actually going deeper with clients, you're supervising as a percentage far less compliance work as a business principal. You now have the resources to deliver to your clients. What we find is that as business owners, you then have the capacity to actually think about communication. How do you get your message out there? And that was one of the interesting challenges when we started the Social Advisor, because I wanted to make this at the beginning something that was different, that was about innovation and disruption and technology and communicating in better ways. And what we found is that most businesses didn't have the capacity to invest into the part that would actually allow them to scale their businesses. And that's why typically we never start with marketing. Typically we start with your business model. You have to build your foundations and get them absolutely bang on before you move on to the next step, the next scenarios. So I'm going to throw open to everyone that's in the chat and say, if you've got any questions for me, how are you feeling about this stuff? I'd actually like you to think about this. If you were to go, across your entire client base and speak to all of them and double their fees. Now, I'm not suggesting that's what you do because it needs to be on an individual basis, right? But I just want you to consider this. Imagine doubling your fees to all of your clients. How does this proposition make you feel? How do you feel about that? What are your fears? Look in the mirror and see where your biases are, where your misconceptions are. And again, this isn't me saying that I want you to just go out and double your clients' fees. I think that's a little bit too unrealistic. Even if you were doing that, it would need to be in the framework of how you're doing it and why and what the value articulation is. But just merely consider it. How do you feel? Do you have the sense of, well, they wouldn't pay it? Well, they'd leave. Perhaps that's where I would start if we were having a conversation about these things. Okay, so I'm just throwing over to my team. Do we have any questions come in from the chat?
Not yet.
Okay, has anyone got anything that they would like to ask me? Now's the chance. So Lucian's put in the chat, for those of you who don't know Lucian's coming on board as a partner at the Social Advisor. So he was actually a client for several years within the business. So has been through a lot of this on the other side of the equation. He mentioned that taking the team on the journey is a really important part of this. Yeah, I would absolutely say that it is. And one of the challenges is that you have to, if you're a single person advisor operator business, well, you're the biggest issue. But if you're just one advisor and then you've got 4 or 5 employed advisor as an example, then it's not just you that needs to go through this change, it's your entire team. And that's why we found that the most fundamental changes and transformation comes at literally sitting down with the advisor and working the way through every single client. Well, who are they? What's really happening in their life? What are they paying you? What's the relationship been like? This is what they should be paying. Let's build a model that now works across the entire business. How do you articulate it? What order do you start doing this with your clients? How do you prioritize it? And honestly, it's something that actually takes change management and practice. Quite often we will sit down together, and I'm just painting some examples here. And together we've worked out a pricing schedule that actually works now for the business, that's profitable and sustainable. And so it might be a client that's on $3,000 and we've worked out they should be on $12,000, and the advisor has the conversation the first time round and gets them to pay $7,000. And we find that tends to happen early on in this process, when in reality, the result would have been exactly the same if you just went to them in the first place and said, this is what we need to charge you for the service that we're delivering. I'd perhaps like to share with you the types of feedback that you get from clients in going through this process. Okay, so, and thanks, Lynn, I appreciate it. I'm looking in the chat now. So what I would say is if you did this across your client base, Lynn, what we tend to find is that clients will give you a small challenge. And I think advisors overreact in terms of, well, someone's really challenging me on this. And what I mean by it is a client, so maybe 10 to 20% of clients will say something along the lines of, oh, that's quite an increase. Oh, are you sure? And then say yes. By the way, that is not a serious fee pressure conversation. It's actually not. So you'll find that a lot of your clients are actually taking a step back to recalculate the value, and you want them to. You want them sitting there thinking, hang on a second, is this really worth that amount to me? As I said, maybe 2 to 3% across the board. If you're really challenging things, we'll say, look, this isn't for us, we're opting out. What we tend to find there is people agreeing yes before the advisor's finished. So that's probably 30% of the clients. And then we have another 30% of the clients that actually say things like, I think this is a good idea, and I kind of thought you were too cheap all along. And it will surprise you how much we actually get that from people. And of course, you think about the human psychology of that. They may be thinking about that, but that doesn't mean they're going to volunteer to you to say, please put our fees up. By the same token, it's also one of the reasons we believe that clients don't refer for businesses that are not charging to a high enough price point, because clients feel guilty. Right? They might not think about it rationally, but subconsciously, there's an inequity of, oh, I'm sorry for everyone. I just punched the microphone. My first time doing that today. There's an inequity between the relationship status of the advisor and client. What you do for people changes their lives. And the more you embrace that, the more you articulate it, the more capacity you have to go deeper with those clients, the better off society is, the better off your individual clients are. So universally, this is the comments that I have coming back from the advisors we've taken on this journey. Conversations feel so much more natural with clients. It feels better. We're engaging in a better way. People start questioning our fees less. It's weird, isn't it? We put our fees up, change the way we focus the value, and even though we put our fees up, clients question fees far less. And in fact, that should be the instance. One of the issues I would say to you, if you get fee pushback from your clients, if you're being challenged on this, then it's probably an engagement issue with how you've taken them on the journey of understanding your value up front. If you do that the right way and you framed it in their life benefit, very rarely do you get pushback from clients in that sense. So I believe we've got a question that's come through. So from Sean in there, for the larger figures and new clients, does the lead to a bigger maybe pipeline as they need to go home and think about it and get stuck in action? No, it doesn't. So there's a good question there, Sean. I'll focus on that one first, and Jeremy's telling me that that we've got another one there as well. So I'll get to that in a second. No, it absolutely doesn't. And in fact, what I would say is it's the definitiveness of you that determines the definitiveness of the value perception of a client. That's always the case. So going away and thinking about it really means that in almost all cases, you've got someone that hasn't translated, or you haven't translated the value into their language. So it's generally speaking an issue with that. And as I said, we have a whole process for how we help advisors get to articulating this point for them. It's just understanding how to ask deep questions and reframe it into client language. But I'm going to throw this one to you. I always give attribution for great work from other people. So a question that I really like, it's from Dan Sullivan. So you can check out Dan Sullivan, just look him up online. He calls it the R factor question. So asking a client, now imagine that you and I were sitting together in 3 years' time, and you were looking back over the last 3 years. What are the things that you would need to see happen personally, financially, professionally, just in your life in general, to feel like it's been a great 3 years? So, I mean, that's one piece of the equation, but it's such a valuable question to ask. And by doing so, what you're actually doing is you're, first of all, having the client imagine that they're working with you in 3 years' time. So psychologically, they're committing to that engagement. Secondly, you're removing the impetus for the immediate issue they think they want value from you about, whether it might be diversifying the portfolio or getting my super sorted or whatever it is, right? And you're refocusing it onto their entire life. So asking that question and then knowing how to dig into the answers they give you is how you then can frame it. Well, here's where you want to be in your life. And with my help, here's how we're going to help you get there. And without my help, this is what you're going to miss out on. And here's why. It changes the nature of the equation. And so what I would say is, no, whether you're articulating the value at a higher price point, it doesn't lead to more inaction. I will say to you, however, that there are some people who will never agree to anything on the spot. That won't change. But typically you will get a yes answer pretty much all of the time if you do this well enough. It's just a much cleaner way to do it. Okay, so I think this was from Sean again. Is there a way to get started with this? I feel as though I would really need to change the way we articulate value to significantly increase fees to a client. Yeah, Sean, there most definitely is. And the start point is, as I said, understanding your own biases and your limitations and overcoming that fear. If anyone wants to go a little bit deeper and perhaps bounce their business scenario office, obviously we can be a little bit more specific in that sense. So please feel free to reach out and hit us up. We'd be more than happy to spend some time with you individually if you're in that particular case. Sean, honestly, I think it's just the first step is to realize where you may have gone wrong in this instance. And again, a lot of the time I hear advisors say, yeah, but we've started out and our clients coming in are typically only earning X, Y, Z, or they've only got X amount of portfolio value. It doesn't matter. Like, okay, fine. Maybe you're not going to be charging them $30, $40, $50, $60, $70, $80,000 in a year, but you can certainly be charging them significantly more than you are now, simply because you define that your value has more impact to them and that you put the emphasis on the outcome for the client. The value is the outcome to the client. It's not the actions you take. And if someone is questioning you on fees and how much you're doing for what they get, never justify yourself based on how much work you put into what they get. If you're ever doing that, you've lost the relationship status. As an advisor, you have to have relationship status over your clients. Otherwise, how are you going to challenge them to see their own answers, to push them on things, to actually get a transformative life experience? And so you always have to bring it back to, well, what is this about? Why are you asking questions about fees when this is actually where you want to be in your life? You've said that you need to have better fulfillment in your career and have a better relationship with your family. We've already established that you're making more money than you need. So I'm not here to answer your questions about having more money. That's not what I'm here for. I'm here to challenge you and say, why are you worried about cost when you're making more money than you need? And the real things you need to change in your life are this. That's how you deal with clients in that scenario and take them back. You always have to take a step back to that fundamental. Okay, guys, we had any other questions come through in the feed?
There was just a bit up.
So there's one from George there. Yes, we need to articulate a value better, not just the tangible, but more important, the non-tangible. Look, what I'm talking about here is exactly that. You have to get the client involved into the process of translating the intangible. So by asking them a question like the R factor question, you actually get their list of objectives. The client should be pitching you what the value is, not the other way around. By the same token, we always suggest that advisors start up front in their conversation with clients with a framework that goes like this: reason, context, value, expectation. Now, I can only go surface level on this in our chat for today. We have a whole module around this. But reason is actually your reason. What's your why? You have to tell people up front your motivations for what you are doing and the kind of business that you're building. It's your business. It's your value first and foremost. You're the pivotal point in this relationship, not the client. And people get confused with that. So they're trying to pitch a client first what they think the value should be to them. No, first you start with your reason. So it's one of the reasons today I said to you guys, why am I doing this? Well, I need you to understand my motivations. I'm obsessed by the value of advice. If I can have you having more impact for your clients because you've got a more profitable business and you also happen to enjoy life a bit better, then I feel great and I can help make my positive influence to the world, because I think advice is the critical gap between our society being better. Advice changes lives, whatever your denomination is, if you actually focus it on life outcomes to the client. So in that sense, start with your reason. What is your reason? What kind of business are you trying to build? Context is then just bridging the gap to value. Well, if I were again to translate my value in that sense so that you can see an example, I would say, well, because I'm so obsessed with this, because I've run my own financial advice firm for 15 years, I've worked inside accounting firms, I've helped, almost 500 businesses individually, like looking behind the scenes, to really get a grasp around where they're at. Because I'm obsessed with all of this stuff, it means I can help advisors take a step back from where they're at to say, where are you at? What do you really want to achieve? Where do you want to get to in your life? And I've done this enough times that I've got a pattern answer to be able to help you figure out how to solve any problem that you possibly have. And why would I do that? Because it's my reason for existing. It's my purpose. It's not about making dollars for it. Sure, I need to get paid and all the rest of it, but I'm doing it because that's what I want to have happen. If you're not that honest with your clients, then you're starting from the wrong frame of reference. The last thing on that equation is the expectation. And so when you're starting your engagement with a client, you have to give them your expectations. This isn't about finding out their expectations. This is about you being brutally honest, or not brutally, but authentically honest up front with your clients. Sales isn't about trying to get anyone to do anything other than get the most value out of you. It's not to convince them. And therefore, the best way to sell is to be the most fundamentally honest with your clients. And I had this question on Wednesday from another firm that we're working on with this process. And we were talking about the issue of, well, I get how to bring this up with a new client, but there's got to be a better place for me to start with existing clients than, cost of advice is going up and I need to talk to you about your fees. And I said, well, yeah, start with the most brutally honest. And that is, you've been undercharging the clients, that you want to be here in a sustainable way for them for the future, that you want to live the kind of life that you would advise them to live, that you want to look after your family and your kids, and you want to make sure that you're actually being valued for what you do and you're going to be sustainable. That's honest. And I've got to put my fees up for you. It's really just that simple. And then explaining to them, and this is the value to you. Tell me, do you agree? Do you find that we've given you this life change in your life? Now, when we talk about intangibles, there's another key tip that I'd like to give you all today, and that is, every year, if you work with the same client and you're engaged with them over a longer period of time, so financial advisors and accountants absolutely fit into this category, then one of the things you have to do every single year is to get them to repeat or to articulate to you what they believe the value they've received out of the relationship. And so the thing about intangible value is it's only intangible because it hasn't been made tangible. In other words, we've got conscious perception and subconscious perception. And so what you have to do is actually get the implicit and make it explicit. So I will always ask the people that I work with, hey, and by the way, I suggest that you start by articulating what value you think they've got from the equation. And it will never be something like, your portfolio's up 12% net this year. Right? That's just a justification for someone who hasn't articulated the life change benefit better to someone and who hasn't gone deep enough on that list of questions. Because a client will never say to you in that 3-year question, if you dig deep enough, I want to have achieved $200,000 return, or I want my portfolio to be worth 1.2 million. What they will actually say to you is, I want to feel like I'm secure in where I'm at, and that I know where I'm heading, and that I'm comfortable and confident that I'm making the right decisions. That's the language they actually use when framed that way. So start the conversation in, and by the way, never use the word review with a client. That's another tip that I'm going to give you. Um, by saying to your client, hey, we want to book you in for your annual review, what are you telling them the value was? What happened before? What are you putting the emphasis on? The portfolio performance they've achieved. So we always suggest something like your annual forward planning meeting or your annual get together or whatever, so long as it is putting an emphasis on the things that are most important. We want to review where you're at and talk about how we get you better outcomes in your life going forward. So be very, very careful with that. Never call what you do a review meeting with a client. It's completely flawed, and you'll stuff up your whole value equation just through that one simple thing. So when you're meeting with your client annually or however often you need to do it, and I'll actually come up to this point in a second. It's an important one that I didn't make before. I would suggest that all of you say to a client, hey, look, by the way, all you got to do is go back a year ago and look at their 3-year list of things. Hey, you know what? I really see some changes in you this year. I see you're more relaxed about what you're doing. You're speaking with more confidence. You've got more clarity around, what you're doing in your career. You've made more effort and focus to spend more time with your kids and not worry about things. We've talked through X, Y. I really see these changes. And you're just reading from this list because that's what you actually focused on translating it to and helping them achieve. And then say to them, can you tell me what you have found has been the value from our work together? And let them articulate it back to you. So now it is not just implied, it's now explicit. So it's a very important step that I'd suggest that you all consider making in this whole challenge of tangible to intangible.
Evolution and Sean.
So Sean, love that. Value is the impact on clients' lives, not the nitty gritty, less important stuff. Yeah, I'm actually going to talk about this. We have some firms that have gone well above 65%. We have one firm that is above 80% EBIT. And so how do you start moving from, well, first of all, it's to understand where the value equation is. So this particular business was working with high net wealth, retirees, pre-retirees. So a couple of $1 million portfolios as being, the average. We went through all of the stuff that we've just talked about previously. But we also looked at, well, what are you delivering to these people? So you're charging a client $34,000 a year now or whatever. And so the impetus has been before, well, that means you must need to meet with them more often. Well, in reality, what I suggest is that most clients will have a better sense of value from you, as I said, in that life outcome. And a lot of those clients may meet with you quarterly or half yearly because you tell them that's your value proposition, when in reality, there are so many things that you could do to actually create more life impact for them. So in the case of above 80%, well, we've got a process where talk to clients. We've switched to doing video meetings. So again, he was saying my clients don't even have email. Well, they're all switched to video meetings now. So the office space requirement is substantially less than it was, which is a significant cost saving. Pre-recording of reviews. So we have conversations with people, record a video presentation of the review. Client has an option with an online calendar system to book in for a 15-minute phone call, to book in for an hour video meeting, or to book in for an hour appointment in the office. And what you're doing is you're actually giving the clients the ability to decide what service level best fits with them. And most of your clients are not going to get the value out of you being in front of their face all of the time. And I have a slide that I use for this to kind of illustrate the point. And on one side, we've got the service model that's been ingrained into financial advice in particular, number of reviews, newsletters, all of this other stuff. And I kind of get a little carried away and I talk about, unlimited feet massages, whatever. So you're just trying to fill out this value proposition with action tasks, versus the other side, which is we partner with our clients, we understand their lives, we're there behind the scenes, we're there to challenge you, to help you find your own answers. When you need help, you call us. When we need you to focus on something, we call you. Otherwise, our job is to disappear behind the scenes so you can get the most that you want out of life, knowing that you've got the right partners with you. Which one do most people want? I can guarantee you it's the second one. And a lot of the time, the work and the effort that you were taking in delivering these things is actually wasted in the impact level that it has to clients. And if I would also delve into the project fees for helping clients with issues in their lives, one of the beautiful things about that is, as I said before, it's just you meeting with them and digging deeper. You're not having to produce statements of advice. You're not having to do all of these other things. And therefore, your profitability for those aspects of the business are significantly greater, more life-changing. And therefore, that's a big part of how you're moving from the 40% EBIT into the 55, etc. So there's plenty of technology that's important in this, obviously using CRMs, using video meetings, understanding how to scale communications. We have a process we call digitizing your client engagement. So sending clients videos to explain a lot of these things ahead, after meetings, etc., so that you're removing the direct emphasis on phone calls, on Q&A, on advisor direct time that's not the most impactful for clients. These are all things that also help contribute to that. David's just actually put something in there which I've seen pop up. Hi, Baz. What is your view on face-to-face personal contact using technology to engage? It's a really, really good question, Dave. Look, in an ideal world, you're going to meet your client face-to-face. But I've got clients that I know incredibly well that we've done amazing things for, and I've never met face-to-face. Video meetings are incredibly powerful. And unless your client doesn't have the capacity because they've got zero internet where they live or where they work, then honestly, you can build a business model which is predominantly video meeting based. And what that also does is it means that you are not geographically dependent anymore. So Dave has got a couple of offices in different more regional areas. And as I said to you the other day, Dave, I think it's really easy for you to make an appointment. So you have an online calendar system, make the assumption that video meetings are the way you do it. Just like when I met with you the first time, I said, well, let's get together. We're having a video meeting. People do it. It just happens. It just works. And in the case of the firm I talked about before, we had this real sticking point. Well, I've got these older clients. They don't even use email half the time. We're never going to get them to switch to this. No, it's just a matter of you articulating the value to them and putting it in the right context and having a change management process. So that is a fallacy, I think, across the board with advice that I've got to do stuff face to face. Video meetings work great. They're fantastic. Now, personally, I still love getting together with my clients and getting the chance to, give them a handshake or a hug or, whatever. I like the affection part of it. And sometimes it's nice to do that in person. But honestly, I've got clients that, work 30 minutes away from our office or sometimes less than that, and we still do video meetings, and it's not a problem at all. So I just wanted to throw that one out there and to dispel the myth that you can only be really impactful and kind of do what I call the punch in the awareness. For anyone who's worked with me for any length of time, you understand the Baz punch in the awareness. My job's to get you to your own answers, and if that means challenging you, then I'm going to care enough to make sure that's exactly what I do. And I think most great advisors, well, in fact, all great advisors do the same thing with their clients. Honestly, I can do that just as well on video as I can in person. You may be talking a 2 or 3% difference in that sense. Okay, any other questions or anything else you would like me to cover? I mean, there's literally I could speak for days in depth on each of these things. I wasn't kidding when I said, and I'm an advice nerd. We figured out how to create video and do websites and how to run events and run Facebook ads and the mechanics of referability and all of this stuff, but only as it relates to advice-based businesses. Okay. So I think that's where we'll call it for today if we don't have any other questions. As I said to you, I wanted to make the focus today not using slides. It's my first speak to a camera live while taking questions. So thanks very much for the engagement. Please do me a favor. I would like to really focus on improving the conversation between advisors. So my plan from here will be to get advisors on to ask them questions, to talk through what they're doing with their clients. So please help me to do that. I want to do it in a non-aligned, non-political way, to go deeper, to be brave enough to ask questions and delve into stuff that maybe hasn't been done before. So if you appreciate that, please make sure to subscribe, to like, and to spread the word. Let's do it together and reinvent the future of advice. Thanks very much, everyone. Take care.